Imagine this. You wake up one morning, check your phone, and see the headlines splashed across every news outlet on the planet. United States officially defaults on its debt. The stock market is closed. Treasury yields have exploded. The dollar has plummeted. And gold? Gold isn't just rising, it's erupting. Panic ripples across the global markets. Foreign nations scramble to reposition. Central banks are silent, but buying. The average American? Frozen. Their retirement accounts in free fall. Their dollars worth less by the hour. Confidence has cracked, and the world is watching. But the real question is this. What actually happens to gold if the most powerful, most indebted nation on earth suddenly fails to pay its bills? That's what this video is about. We'll walk you through the mechanics of a US default, past close calls, chain reaction that would follow, and how gold, an ancient, silent asset, could become the eye of the storm. You're watching Don Gilded, where we chase the metal, not the hype. Let's begin. What is a US debt default? Let's strip away the fear and look at the facts. A debt default doesn't mean the US goes bankrupt. It means, for a brief or prolonged moment, America fails to meet its scheduled obligations. That could be anything from missing an interest payment on Treasury bonds, to delaying payments to government workers, to suspending Social Security checks. It's not about insolvency, it's about confidence. There are two key types of default. Technical default, temporary, caused by a delay, political standoff, or administrative glitch. It's resolved quickly but still damages credibility. Actual default. A missed payment on principal or interest, this is the nuclear option, and it would send shockwaves through every market in the world. Has the US ever defaulted? Not fully, but it's come close. In 1979, the Treasury delayed payments on $122 million of Treasury bills. The reason? A combo of back-office computer issues and a brief debt ceiling crisis. That delay caused interest rates to spike by 0.6%. Markets didn't forget. In 2011, the US was just days away from running out of cash. Political infighting held up a debt ceiling increase. The result? Standard & Poor's downgraded America's credit rating from AAA to AA+. It was the first time in history the US lost its perfect rating. Gold soared to over $1,900 an ounce, a record at the time. In 2023, the same script nearly repeated itself. The government reached the debt ceiling. The Treasury took extraordinary measures to stay solvent. Markets braced for impact until Congress barely avoided disaster. No full default yet. But make no mistake, America has danced on the edge more than once, and each time, gold has quietly prepared. How gold behaves in times of fiscal crisis. Gold is a truth detector. It doesn't care about headlines. It doesn't care who's in power or what the latest press release from the Treasury says. It only reacts to one thing: broken trust. When systems shake, when governments stall, when currencies are diluted into meaninglessness, gold listens and responds. Let's go back to 2011. The US government was on the brink of missing payments. A partisan standoff nearly stopped the flow of capital through the most trusted financial system on earth. And what happened to gold? It climbed. Hard. From January to August, gold prices rose over 25%, peaking near $1,900 per ounce, a record at the time. And here's the kicker. That was before a default even happened. It was just a threat. Just the idea that maybe, just maybe, the United States wasn't invincible. Now jump to 2008, the financial crisis. Banks failed, credit froze, Lehman collapsed. At first, gold dropped. In a liquidation event, everything sells, but within months, it snapped back and began a multi-year bull run. Why? Because in that moment, the world realized something terrifying. The system was running on debt, on leverage, on hope. And gold? Gold needed none of that. It had no yield, no board of directors, no bailout clause. It didn't need to ask permission. It simply endured. Fast forward to 2020. The pandemic hits, lockdowns spread, supply chains break. And in a matter of weeks, the US government prints over $4 trillion, injecting it into the economy to stabilize the freefall. It worked, for a time. But gold noticed. It broke $2,000 per ounce for the first time in history. Not because investors were chasing yield, but because they were chasing certainty. When trillions are created from nothing, when stimulus becomes strategy, when inflation becomes transitory until it isn't, Gold becomes the final vote of no confidence. Time and again, crisis after crisis, gold steps forward. Not because it's exciting, not because it promises returns, but because it survives. It doesn't default, it doesn't dilute, it doesn't apologize. It just is. Silent, sovereign, untouched by human error. And as Ray Dalio once warned, if you don't own gold, you know neither history nor economics. He wasn't being poetic. He was being practical. Because when the music stops and the system starts to unwind, gold isn't a hedge. It's the truth beneath the noise. The chain reaction of a US default. Now let's walk through what would actually happen if the US did default. First, the bond market would spiral. US Treasury bills notes and bonds are considered the foundation of global finance. They're used as collateral for loans, repo markets, and banking systems worldwide. If even one interest payment is missed, panic sets in. Investors sell treasuries, interest rates spike, banks tighten, and liquidity dries up. Second, foreign nations react. China and Japan alone hold over $2 trillion in US treasuries. If they see risk rising, they start dumping, causing a further plunge in prices and faith. Third, the US dollar weakens, fast. The greenback's strength is built on the assumption that the US will always honor its debt. If that's broken, the dollar loses its unique status. Fourth, the Federal Reserve steps in. But here's the paradox. Calm the crisis, they'll likely print more money. They may inject liquidity, lower rates, or even restart full-scale quantitative easing. And what does that do? It pushes gold even higher. Because the moment you use debt to fix a debt problem, gold becomes the only asset that can't be diluted. Real gold price scenarios. So what does a US debt default actually look like in terms of gold's price? Let's break it down into three possible paths, each based on real data, historical patterns, and the macroeconomic forces that shape how gold moves when the world shakes. Scenario 1, controlled chaos. Gold at $2,800 to $3,500 per ounce. In this first scenario, the US does default, but only briefly. It's a political stunt. A high-stakes game of chicken in Congress. Markets panic at first, but the issue is resolved within days. The Treasury resumes payments. The Fed injects liquidity, and leadership reassures the world. But the damage is already done. Credit agencies may still downgrade US debt again, and headlines worldwide declare the US unreliable. Investors remember the scare, and they reposition not all at once, but gradually. Gold in this case becomes a refuge, not a revolution. Prices could spike sharply, moving from current levels to the $2,800 to $3,500 range, as buyers flood in. But once the crisis subsides, prices likely stabilize at a new baseline. This is a scenario of contained damage, where gold surges but doesn't explode. Scenario 2, systemic confidence breakdown. Gold at $5,000 per ounce. This is more serious. The default lasts longer than expected. Political dysfunction escalates. Foreign governments begin to lose confidence, not just in US leadership, but in the dollar itself. China and Japan begin quietly dumping treasuries. Sovereign wealth funds and central banks across the world start diversifying away from US debt. Emerging markets flee the dollar, turning to gold, oil, and alternative currencies. Suddenly, de-dollarization isn't a theory, it's a trend. Inflation creeps back in as interest rates rise and the dollar weakens. Domestic buyers, already nervous from a decade of monetary policy acrobatics, start pouring into gold. Institutions follow. In this scenario, gold crosses $5,000 per ounce, not from a blowout rally, but from a slow, relentless shift in global trust. Gold doesn't just hedge inflation here. It becomes the primary safe haven asset, displacing bonds, tech stocks, and even cash. Scenario 3, the global reset. Gold at 10,000 plus per ounce. This is the unthinkable. But let's think it through. In this outcome, the US default spirals into a full-blown crisis of confidence. The dollar, once considered untouchable, no longer commands the world's faith. The debt is no longer seen as safe. It's seen as toxic. Global markets freeze. Major bondholders demand debt, restructuring. Credit downgrades come in waves. Domestic investors panic. And the Fed? Out of tools. In the vacuum, the IMF steps in. Not with a bailout, but with a proposal, a new global reserve system, likely based on special drawing rights, SDRs. But this time, those SDRs are partially or fully backed by gold. Gold is revalued, officially or unofficially, as the anchor for a new monetary order. Central banks buy aggressively. Supply dries up almost overnight. Physical delivery becomes difficult. The paper gold markets break down. Premiums explode. In this world, gold hits $10,000 per ounce and keeps climbing, not because of speculation, but because it's the only remaining trust-based collateral in a broken financial system. Let's be absolutely clear. A $10,000 gold price isn't about profit. It's not about traders winning or funds celebrating. It's about survival in a world where the system people once trusted has finally failed them. This scenario is rare, but in a debt-soaked global economy with a central reserve currency built on promises, not assets, it's no longer unthinkable. It's just a matter of sequence and timing. How the world reacts. A US default wouldn't stay in US borders. It would trigger a monetary earthquake globally. China would likely accelerate gold buying and further reduce dollar exposure. Already, they've been cutting US bond holdings for years and quietly boosting their reserves. The BRICS nations, Brazil, Russia, India, China, and South Africa, would push even harder for a new gold-linked trading currency. Some reports suggest they're already in early development. The IMF could issue more special drawing rights SDRs. But here's the catch. Special drawing rights are partially backed by gold. So even the IMF would be buying. Every institution, public or private, would begin to reprice risk, and gold would quietly become the foundation of every conversation. Could this really happen? Some say the US can't default because it can print money. That's true, until it isn't. A nation can always meet obligations in its own currency, but that doesn't mean its money holds value. Zimbabwe printed, Venezuela printed, Argentina printed, and their citizens paid the price. Even the US dollar, historically stable, has lost over 96% of its purchasing power since 1913. Default doesn't have to be official. It can come in the form of stealth devaluation. Still skeptical? Watch for these warning signs. Rising credit default swap prices on US bonds. Weak demand at Treasury auctions. Large foreign bond sales. Political gridlock with no resolution. All are symptoms of a system under stress. What should you do? You don't need a PhD in economics to protect yourself. Start by asking, what's backing the assets I own? If the answer is debt, derivatives, or government promises, you may be more exposed than you think. Physical gold, held securely, not promised on paper, is one of the few assets that carries no counterparty risk. Watch for bond market tremors, congressional gridlock, sudden rate policy changes, gold central bank activity, especially from non-Western nations. Because when the music stops, everyone runs for the same chairs. Question for the comments. If the US defaults, how high do you think gold will go? Final words. Here's the truth no one wants to say out loud. Gold doesn't default. Nations do. It doesn't rely on trust. It doesn't promise returns. It just exists, as it has, unbroken, for over 5,000 years. If the US defaults on its debt, even for a moment, it won't just change markets. It will change beliefs. And in that kind of world, gold won't be a trade. It'll be a signal. You've been watching Don Gilded, where we chase the metal, not the hype. Stack wisely. Share this with someone who needs to hear it. And get ready, because the system's cracks are no longer invisible. They're echoing.
Real quick, if you're the kind of person who doesn't trust the system, who sees the writing on the vault walls, I made something for you. The first official Don Gilded drop is live. These aren't your average shirts. They're a statement, a warning, and a nod to the ones stacking metal while the world burns paper. Links below. Limited supply. Because truth doesn't mass produce.